Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner, and founder of Menninger Associates Financial Planning. Really excited for our episode today. In fact, it's going to be a two-part episode. As you know, with my show, I always like to talk about subjects of the 6 areas of financial planning, which is cash management, tax planning, investment planning, retirement planning, estate planning, and investment planning. I don't know if I said it or not, but anyway, so today we're going to be talking about investment planning. As I indicated, this is going to be a two episode thing. So for disclosure, today is Friday, August 5th. So we air next week. So when it comes to economic data, it's remarkable how a day or a week can be like already outdated. So, if you're viewing this, please understand that this is, Friday, August 5th. And with that, and no further ado, I want to welcome my guest, Thomas Balis. Thomas, thank you very much for joining. I appreciate it. Thomas is a chartered financial analyst with Cornerstone Investment Research, and as a CFA, which I am extraordinarily impressed by the designation, we've hired your firm, and I'm proud to say that we've hired Thomas's firm and his group of CFAs to serve as our personal chief investment officer. So thank you very much for joining me today. Real quick, tell me a little bit about yourself and your firm before we jump in.
Yep, so Cornerstone exists exclusively to support other investment advisors, firms like yours, in helping their clients achieve their goals. And so I get out of bed every morning feeling like if I can help advisors be successful by enhancing their portfolio management and investments that they include in them, that I'm making the world a better place.
That's good. Well, we enjoy what we do. I love what you do, and I can tell you that you've done a lot to really enhance the value that we bring to the clients. So last week I referred to in my weekly market recap, last week was the trifecta, okay? And the trifecta being last Wednesday was when the Fed announced its rate hike of 75 basis points or 0.75%. Then the GDP data came out, which was controversial a little bit, and then we had earnings. So we, right in the midst of earnings season, although we've crossed over the hump, have more than half of the companies in the S&P 500 reported their earnings?
Yeah, last week was certainly a big week for it.
Yeah, so what we're going to talk about today is the first episode. We're going to be talking more about the definition of the recession because that was a controversial topic. And then the second episode, we're going to be talking about inflation, which is the 800-pound gorilla in the room, and what the Fed's doing as far as interest rates, and where each of these impact the economy, and obviously how it impacts the economy. People are always interested in, I don't want to say they don't care about the economy, but they care about their portfolios and how's my 401k doing? Is my 401k now a 201k? That was the joke. Not a funny joke, but it was the joke in 2008, as you know. So let's talk about the GDP growth. So they reported GDP. The commonly known definition of a recession is 2 consecutive negative GDP reports, meaning that the U.S. economy was less than the prior quarter, and they say 2 consecutive, and we're in a recession. Well, guess what? We had 2 consecutive. Now, what this chart shows, it goes back 10 years. And you can see in the latter part of the chart that it kind of goes down a little bit. Looks like a straight line, but it's actually 2 consecutive quarters. That's the definition of a recession. Share with me your thoughts on that, because there's more to it.
Absolutely, and I think it's important to look through the numbers and look underneath them to really understand what's going on, because so much of what we've seen in the GDP numbers has really been driven from the COVID pandemic.
Absolutely.
And so, wrapping up the end of the year last year, we saw GDP growth over 5%. And one of the things that we've probably forgotten about over the last 6 months is that out in the port of LA, for example, there were container ships just lined up and unable to get their merchandise unloaded. And that had a pretty significant impact to the Q1 number in terms of how it impacted inventories. And then when you take a look at the Q2 number, again, of the 0.9% that we were down, 2% of that came from inventory drag. And then another 0.7% of that came from real estate because interest rates went up so much. You saw a decline in real estate growth. And so those two things combined really pulled the overall number down. And while consumer spending was good, it wasn't quite enough to offset the drag from inventories and from real estate.
Well, consumer spending has, it's 68%, 70%, two-thirds, somewhere. It's the largest part of the economy, and the consumers haven't stopped spending.
They haven't. So when you take a look at bank level data, there was a piece from Brian Moynihan from Bank of America a couple of weeks ago that talked about how the average consumer bank balances have increased. If they had a balance of X thousand,
Really?
A year or two ago, it is more like Y thousand. And on average, across many demographic segments, they saw an increase in bank balances.
Since when, though? Since pre-pandemic, or well, absolutely.
So yes, since pre-pandemic, and a lot of that came from not only government stimulus in terms of enhanced unemployment benefits, stimulus checks, child tax credits, those kinds of things. But then you've also got a rise in wages that has driven in some of those balances, and so consumer spending has remained strong. If you take a look at high frequency data like credit and debit card spending, those numbers have rebounded sharply since the onset of the pandemic.
Well, the other thing about the pandemic is that even if you wanted to go to dinner, you couldn't because the restaurants were closed. Even if you wanted to go on vacation, you couldn't because the vacation destinations were closed, the airlines were closed, the cruise lines were closed, or you didn't even want to get near it because of the pandemic. So it was accumulation of assets.
Well, and you certainly saw that was one of the things that kept the second quarter GDP number from being worse, because you saw that the rebound in travel and leisure. So
right.
if you got on an airplane in the month of May or June, you probably saw sold out flights. You saw prices going up in those areas. You saw hotels bookings were extremely high, and so you saw this pent up demand of folks that hadn't been able to take a vacation that wanted to be able to take one. And so that was one of the reasons that the GDP number wasn't worse than it could have been.
Well, so also business travel. Business travel was shut down almost entirely in 2020, just knowing a lot of people that we work with, that companies were shutting down any type of business travel. That's picking up again.
Absolutely. And if you take a look at the TSA numbers, if you look at the weekend numbers when consumers tend to travel, those numbers are almost on par with what we saw back pre-pandemic.
Okay.
Business travel has caught up largely, but it still trails significantly, reflecting the ongoing hybrid work that many have begun to adapt to. And so while you see business travel coming back into play, it's not quite back to where it was.
Well, this is going to be an underlying theme that's going to come out probably several times during the course of this episode as well as the next episode, jobs. And, we're looking at the airlines. So you brought up the airlines, and I'm thinking about all of the flights that keep getting canceled. And I'm almost afraid of taking a vacation simply because not of COVID. I hear nothing but war stories about people, either their flights are canceled. One of the guys who works with me couldn't make it to a bachelor party in Montreal because his flights got canceled. Took my brother an act of God to get home from Wisconsin because flights canceled everywhere else. So, how is that impacting GDP? Is it, or just it's nominal?
Well, I mean, the reality of it is that airlines have been preemptively canceling flights in advance in anticipation of staff shortage. So that is going to have some nominal impact to it. But again, fares went up significantly, and so you got to think that those two things are likely to balance each other out.
Okay, so now the big, it was actually almost a political debate, and understandably so, because I've never seen such a political divide that's been increasing. The one side of the aisle wants to say how bad things are, and the other side of the aisle wants to say how good things are, and so that's what sparked the debate. The debate was 2 consecutive negative GDPs is the definition of a recession. However, not necessarily. And I think we have another slide on this. The National Bureau of Economic Research was, I don't know, since 1928 or even since 78, they've been tasked with it's your job to define if we're in a recession or not. And I read it, and it was sort of a weak thing. But what this slide shows is the 6 areas that the National Bureau of Economic Research looks at, and they're all positive.
For sure, yeah. So the National Bureau of Economic Research, who does have the official job of declaring when business cycles start and stop, defines a recession as a significant decline in economic activity that's spread across the economy and lasts more than a few months. So there's a lot of wiggle room.
Yeah, no
in
kidding, a
that
few
definition.
months. What's a few?
Yeah, exactly.
Is that 3 or is that 4?
Yeah, for sure. But they do look at 6 different areas, and when you take a look at the 6 different areas, you've got a mixed tale, but all of them are positive. You take a look at real personal income, less government transfers, and those numbers are higher. You take a look at consumer spending, and while May did fall off just a bit, June rebounded, and so those numbers are higher. You take a look at real wholesale and retail sales, and those numbers are higher, albeit modestly. And so, those are 3 of the areas that they look at that, continue to be positive, although maybe not as positive as they were.
Right.
Where the numbers get a little bit stronger, and I think you could make the case, for the case against a recession, would be when you take a look at industrial production. And despite the fact that manufacturing production was down 0.5%, or 0.5%.
Right. Okay.
Yeah, industrial production overall was up. And in particular, when you take a look at the employment numbers, and we saw a monster employment number this morning, 528,000 jobs created as of the jobs report this morning. And even when you take a look at the household survey for employment, which tends to run a little bit lower, those numbers have been very, very strong. With the labor market being so much stronger than the rest of the economy, it's highly unlikely that the committee from NBER is going to be able to conclude that a recession has actually started.
Right. And so that's what we're looking at. And not only that, but you look at the numbers and they're all positive. They're positive, but weakening. And the other thing that we also look at is leading economic indicators. Mm-hmm. And if I remember correctly, I think 6 of them are still positive, correct? 6 out of the 10?
Mm-hmm. Yep.
So they're weakening too.
Yeah, and when you take a look at the jobs number like we were talking about, that's more of a lag indicator. So, for example, that GDP growth that I referenced earlier from the 4th quarter, that provided a tailwind that led to some job growth in the 1st and 2nd quarter.
Right, I've read that.
That helped bolster that. I'm sure in some ways played a part in that 528,000 jobs that we saw created for June in today's data release. But when you want to look at a leading indicator, you want to look at like initial unemployment claims. And what we've seen is that those numbers have been inching up. And so, it's hard to express concern about unemployment when the number dropped back down to 3.5% this morning, which is as low as it gets, 3.5%. So on that hand, you say, well, how can you be concerned about unemployment? But when you look at initial claims, which are that leading indicator, they crept up from like the 160s back in March to, if you take a look at the moving 4-week average, we're up in the 260,000 range as of yesterday's claims. And so, that leading indicator says that things may be softening a bit despite robust jobs creation.
Right. Well, so there's less jobs being lost than there are available. That implies positive, which is why unemployment is so low.
Yeah, so, and if we take a look at one of the next slides, I think if you take a look at the number of job openings out there.
Right.
That JOLTS report came in at 10.7 million job openings. You have almost like 2 people looking for every job that's out there. And if you take a look on that chart, it's the lowest it's been as far back as that chart goes.
Right.
And so you've got just this enormous number of jobs and just simply not enough workers to fill them.
Right. That's the slide right up here. Okay. So I was amazed when I saw this in that there are right now, for every person looking for a job, there's 2 jobs.
Mm-hmm. Almost, yep.
So that kind of goes hand in hand with the 280,000 new unemployment claims with 538,000 new jobs. This is why the labor market is so tight.
Yeah, and it's one of the reasons that in today's numbers we saw that average hourly earnings were up another 5%.
That's because it's the employees market, so to speak, as opposed to the buyer and the seller's market in real estate. Was it the Great Resignation? I mean, I remember driving around and passing a Wawa, and actually stopping in a Wawa, and it said $500 bonus just to take a job. Mm-hmm. I was like, wow, really? And then what I looked at is it was a little sticker on the glass, and I looked behind the sticker, and on the sign inside, it said $250. So they raised it because they just can't get people to work.
Well, and some of that is just a function of, a lower participation rate. We did see the participation rate this morning drop to 62.1.
Explain that. What is the participation rate?
So the percentage of people that are actually actively seeking work.
Seeking work or working?
Seeking work.
62% seeking work?
Or seeking work and working combined.
Oh, okay. I was going to say, holy smokes.
Yeah.
So it's 62 point. Now, there are two different numbers. There's one for anybody 18 and older, and then there's 18 to age 64. Which one are you referencing?
18 to 64.
18 to 64, which is more realistic. So 18 to 64 is 62.1% now. What was it pre-pandemic?
It's actually
higher or lower?
Well, I can tell you that the number of jobs that have been created have risen back above the pre-pandemic limits, the pre-pandemic levels. I don't recall exactly what the participation rate was pre-pandemic, but what we have seen is a trend when you looked at the survey data. Whereas if you looked last fall, for example, and you looked at ongoing unemployment claims, you might have saw 3 million people that were unemployed or not in the workforce due to COVID. And then that number came down the quarter later to like 2 million and something, and then down to 1 million and something.
Right, I remember that.
And so we've seen a decline in the number of people that are not in the workforce because of COVID. The other piece has an impact is just the ongoing, graying of the baby boomers. And so as those folks continue to retire, that's fewer people that we have in the workforce. And that's a big component, back to our GDP conversation earlier. Population growth plays a significant role in terms of our gross domestic product. And so, the working population aged 18 to 64 has only grown by 0.1% annually since 2019.
Right, and I saw the same number for all 18 and above being 0.6%, which basically is demonstrating that the baby boomers are now moving into 65 and older. We're at a break right now. Please stay tuned. We'll be right back, and we'll pick up right where we left off. We'll be back in just a few moments.
Have you saved enough for retirement? Are you financially prepared for an emergency or unexpected event? Have you thought about your financial future?
Hi, I'm Mike Menninger, founder of Menninger Associates Financial Planning. For over 20 years, we have been answering our clients' questions just like these as we develop unique and comprehensive financial plans tailored to meet their needs. When addressing your financial plan, we incorporate your entire financial picture, including taxes, estate planning, as well as investment planning and retirement planning. So call us today for a complimentary, no obligation consultation.
A unique approach to financial planning.
Welcome back to Financial Planning Explained, and I'm here with my guest, Thomas Balis, Chartered Financial Analyst, and we're continuing on talking about the economy and the recession, or the so-called recession. Is it a recession? Is it not a recession? And where we left off before the break was talking about the jobs. And so jobs are being created, there's not enough people to fill them. And so that has created wage growth. Very simple. Economics 101, supply and demand. If there's a giant supply of jobs and nobody there to take them, now they're going to have to pay people more, which is creating wage growth.
Absolutely, and we saw that across broad segments of the economy. I mean, whether it was the local grocery store, the local gas station, where people that used to get paid $10 or $12 an hour were getting paid $15 an hour,
right?
Or if it was an Amazon workshop or warehouse where it used to be $15 or $20 an hour, it was more like $22 an hour. And even like my landscaping company that came out, and there was such a big increase. He's like, yeah, the guys I used to get for $15 to $17 an hour, I can't get them to show up for less than $22, $25 an hour. And so we saw wages grow significantly across a broad swath of different kinds of sectors of employment, and we're continuing to see it with a strong average hourly earnings up 5.25%, I think, this morning.
So what that does, though, is that creates inflationary pressures again, because if all of my employees, I work for, I own the grocery store, if all of my employees if I'm having to pay them more, then that's eating away at my profits, and the only way I can increase it, which is now we're talking about inflation, which is going to be the main topic of the next episode. But let's go back to that again. With wage growth, I have two questions that are completely independent of each other. With wage growth, is that good for GDP and the economy?
In some ways, yes, because if consumer spending is 68 to 70% of the economy, and consumers are earning higher wages,
they're spending more.
Then they're spending more.
All right. So, do you foresee, since we've had such a rapid run, if we have a flip-flop? Right now, we've got more jobs than there are people. Therefore, employers are paying more to get somebody to fill the job. If we see a flip-flop in that, do you see wage growth actually going negative?
Well, it depends on whether you're talking about real terms or nominal terms. I mean, because inflation, as we'll talk about in our next episode, has an impact there. But I mean, clearly, things will have to come back into an equilibrium. Right now, there's a greater demand than there is a supply. And so we know that over the long term, that those two forces will come back into balance and intersect. But for now, what we're seeing, and we're seeing it even in some of the leading indicators right now, and we talked about initial job claims earlier, but before people get laid off or lose their jobs, what you see is a pullback in the number of jobs being added, or in hiring, or you'll see hiring freezes. And we've even seen, with some announcements from a variety of companies over the last few weeks about companies are scaling back on their hiring. And when we looked at the JOLTS numbers, I mean, those numbers came down to 10.7 million. They had been up as high as 11 and 12 million at one point. And so while we still have a very, very robust, strong job market, there are signals on the front end of it that it's becoming slightly less robust.
Right, which in some regards is good, I want to say. But I'm going to flip to a new slide that I think is really neat. It looks busy, but it's consumer confidence versus time. And this was prepared by JP Morgan. And when I looked at it, first of all, it took me a little time to figure the darn thing out. But once I did, it was remarkable. And if you look at the slide, it shows every time we hit a bottom, it kind of shows how the market did. This is a perfect example of contrarian.
Absolutely. And so, this is the University of Michigan Consumer Confidence Survey information on the chart. And, what it's showing is that as consumer confidence peaks, that forward-looking returns in the stock market tend to be lower than the 12-month forward returns after consumer confidence bottoms. And that's interesting, and I think important for viewers today, because we saw in June the consumer confidence number hit an all-time low.
Right.
And while it rebounded very slightly in the month of July up to 51.5, it still remains very, very low when you compare it to other periods on the chart. And in general, that historically has been positive for forward-looking equity returns.
Right, and so that goes hand in hand with Warren Buffett. Warren Buffett always said, buy when sentiment is at its worst and sell when enthusiasm is at its greatest. And it kind of shows that.
Yeah.
And so the two spin-offs that I once asked the JP Morgan folks, I'm like, well, I saw this graph before. Why is it that we're lower today than in 2008 when things were horrible. We're in the middle of the recession, the global recession. And the answer he gave me, which was very fascinating, was because of social media.
Social media and gas prices.
I was just going to say gas prices too,
Yeah.
because we talked about this the other day. It's like every single day, if I drive past a gas station, 2 gas stations on the way to work, 4 times a day I am being advertised on the prices of gas.
Yep, absolutely.
And we reached a point where it was breaking 5. It was breaking 5 national average. But I remember that, a lot of the gas stations in my area are Wawa, and a lot of the other gas stations were stopping at $4.99 when the national average was over. I think just from a mental perspective, they didn't want it to go over $5. But now we've noticed, and I heard them announcing that it was 51 days in a row of decreasing gas prices. I have to imagine that has to have a lot to do with consumer confidence.
Yeah, and I think you see that in the slight rebound from the July number. But yeah, there's an incredibly high correlation between the price at the pump and consumer confidence. But it's not the only factor, but it's the one that we see when we drive back and forth to work every day. The other factors are things like food prices, for example. And I know we'll talk about inflation in the next episode, but food prices have been high. I get my own inflation report every Saturday when my wife comes home with the grocery bill. And so, consumer confidence when it comes to prices at the pump, prices at the gas station, and then the amount of amplification that it gets via social media, as you mentioned
Absolutely.
earlier. It's bad news has a megaphone now that it didn't have back in 2008.
Absolutely, and good news too. But usually, news is usually bad news spreads faster than good news. So we got to wrap up this episode already, believe it or not. Back to the recession again, whether it's a definition of a recession or not a recession, in my personal opinion, who cares? It's academic. Whether we're in a recession or not is irrelevant. Are we continuing on the downward slide? And how long? I know, where's the crystal ball? I got a crystal ball, I know it just didn't come with instructions. So, are we continuing on the downward slide, and what do you anticipate will be the catalyst for it to get out?
So, in terms of economic growth, it's hard to imagine that we'll see another contraction yet for quarter 3. I mean, just because I don't think those numbers are in the cards.
So you think the GDP is going to go positive in Q3?
I do.
Okay, good.
Yep. And while I don't spend a lot of time focusing on predictions, I tend to prefer to focus on what we see now.
Right.
One of the things that I think it's useful for many of our viewers when we take a look at what's going forward is the context of their portfolios, and specifically, back to our consumer sentiment piece. A lot of folks, if they opened up their 401k statements, they've had a little bit of a nasty surprise this year.
Yeah, except this month was a good one.
Yeah, July was. Yeah, if they're on a monthly statement, they got a good July statement.
Exactly. Q2 was horrible because the 2 out of 3 were really bad months.
But the first half of this year has been really tough across asset classes for investors. And the question I ask myself is that will markets ever get back to where we were at the beginning of the year? And if your answer to that is no, they're never going to get back there, then we got bigger problems.
Right.
But if the answer is yes, and I think it is, then it's really just a question of time.
Right.
And so
Exactly.
Will markets get back to where they were by the end of the year? I don't know. Will it take it a year and a half? Will it take it 2 years? Regardless, you've got a lot of upside from today's current levels.
Of course.
And for our for the clients that we tend to support, most of the clients the end clients for firms like yours are long-term investors. And so with time horizons that span decades.
Right, of course. Even if people are, and that's one of the things that I preach to my clients, is that even if you're retiring at age 65, your money still needs to last you 20 to 25 more years. So Thomas, thank you very much. We're wrapping up this episode. So we're going to jump right into another episode where we're going to pick up where we left off here, but the crux of the next is going to be talking about inflation and the Fed's response to inflation. And of course, we'll be continuing to talk about the economy, the impacts of the economy on inflation, and the impacts of inflation and the Fed's response to it and the economy. So thank you for joining us today. I thank you for being with me, and we'll see you on the next episode of Financial Planning Explained. And I'm your host, Mike Menninger, Certified Financial Planner. Thank you for joining. We'll see you next time.